Hi everyone, a very good afternoon. You're watching the newsroom on ET now with me, Mubina Kapasi. Markets looking pretty steady. We are once again recovering from the low point of the day. So 10,350, fast approaching that 10,380 high. Sensex as well, firmly above 35,000. So no complaints, and it's really Glenmark is something that we just cannot peel our eyes off. 35% higher as we speak on the back of that drug approval. Yes, we did speak to analyst Surjit Pal earlier in the day, who did believe that maybe this run-up is a little unwarranted. But yeah, the fact is that Glenmark is now beyond 530 rupees. The other big gainers are also the Bajaj pack, Bajaj Auto, Finance and Finserv, all three among the top nifty gainers today. Well, let's move on and talk about Q4 numbers. We're still seeing Q4 numbers trickle in. Obviously, on account of the COVID pandemic, companies have not been able to stick to the earlier schedule of, conducting board meetings and announcing fourth quarter numbers. So ENIL is one such company that's delivered its fourth quarter numbers. There's been a dip in the revenues, coming at 149 crores. Margins as well have compressed. But interestingly, radio listenership in the top cities has grown by 55%. I guess that comes as no surprise, as India does, of course, lock down. So let me introduce Prashant Panday, MD and CEO, as well as N. Subramanian, ED and Group CFO of Entertainment Network. Gentlemen, thank you for joining us today on ET Now. Prashant, let me come to you first. It's obviously been a tough quarter, and COVID-19 has led to this major drop in advertisement revenues and profitability. So let's start off first with ad revenues, as companies obviously are going to try and conserve cash. What sort of a drop have you seen in ad revenues? If you could throw some highlights over there.
Quarter has been impacted towards the end of March by the COVID-19 phenomenon. But don't forget that the larger impact that we've been grappling with really is the economic slowdown, which we've seen, for like almost 2 years now, and which was quite strong in the fourth quarter by itself. So all put together, our revenues are down by 14.8%, which translates to about 26 crore rupees in revenues. But 16 out of this 26 crores is on account of COVID-19. So the bulk of the downfall is because of COVID-19.
All right. Let's now talk, of course, about, margin pressure. There's been a drastic fall in EBITDA margin. So, Mr. Subramaniam, will the new normal for margins be at that 15-16% level that we've seen in Q4?
There are two aspects to our business, right? There is the FCT business and there is the solutions and non-FCT business, which also has a digital element, right? In the solutions business, our margins have actually expanded in the quarter. Gross margins have gone up by close to 300 basis points, despite a lower level of activity. So that's a very, very encouraging sign, and we are on a very strong trajectory as far as the margin improvement in our non-FCT business. As far as the FCT business is concerned, what happens is when there is a revenue drop, right, it goes and impacts margins directly because there are no levers, right? Essentially, about 93% of the top line is the gross margin in the FCT business. So the margin pressure that you see is because of the drop in the FCT revenue. There has been a strong growth and improvement in the margin profile of our non-FCT business, right? Okay. But that's not visible in the overall numbers because of the sharp decline in the FCT business. And I think as and when the FCT business resumes, we have a very weak ad environment currently. As and when, the growth resumes, the margin will also improve.
If you notice that the revenue is 26 crores, but importantly, we have to look at all the other things as well that go behind the revenue drop. The revenue drop of all other radio broadcasters has been far higher. And if you notice, we made the statement that our market share, actually, revenue market share has climbed up by 6.5 percentage points in the last 2 years in the fourth quarter. That's
Prashant, what has been the revenue market share and what's been the solutions margins as well?
So like I was saying, our revenues have actually, the revenue market share has grown very significantly year on year. It's a phenomenon that started 2 years back. And in the last 2 years, our revenue market share on an all India basis, which includes markets where we are not present, we don't have a channel, the revenue market share on an all India basis is now approximately 35% in the fourth quarter, which is about 6 percentage points higher than 2 years back. But if you take only the markets in which Mirchi is present, and there our revenue market share is even higher at approximately 38%, and that is a 6.5 percentage point gain over there. So, but what I'm saying is that basically the radio business, which is the prime driver behind this market share, remains very strong. And especially during the lockdown period, we have also noticed that the consumption of the medium itself has grown dramatically. People are spending twice as much time on the medium as they were doing in the pre-COVID days. The reach of radio has increased by more than 50%. So the medium has done actually very well during the lockdown. And like I said, Mirchi has done very well on the revenue market share. Now, on the solutions piece, and Subbu has already talked about the margin expansion, I want to talk about a little something extra as well, which is the fact that one of our components of the solution business is the digital business. And the digital business is growing very rapidly. And remember, that's the most important part of our transformation. Digital business grew by 37% in the 20. It grew by 24% in the fourth quarter. Remember, in a quarter where every major hit, the digital business of Radio Mirchi, which is still small, has grown very rapidly. Today, the digital business is approximately 3% of our annual revenues, and we see that this will be rising very rapidly in the future. And a small point on the solutions business overall, that because of the margin improvement, and this has been a concern over the years, but because of the sustained margin improvement, today our solutions business gross profit margin is 36% during the full financial year 20. And the EBITDA margin, which includes people costs and other costs which directly affect the business, the EBITDA margin is also up at 18%. But here is the best part about the solution business. We generated an EBITDA of 33 crore rupees during the year with an investment of just 15 crore rupees. That's the best part about the solution business.
Okay, Mr. Subramaniam, when do you think we can see a pickup and, an improvement in performance for ENIL?
So there are two factors, both external and internal, right? As far as the internal factors are concerned, we've taken a number of measures to reduce our cost. And some of this has been pre-COVID, and we have sort of accelerated some of these cost rationalization post-COVID. So we are well prepared as and when the upturn happens. As to when the upturn happens, our expectation is that probably by the third quarter, things will start improving. The first quarter has been really bad, and second quarter we may see a bit of a recovery. I'm not too sure about that, but come third quarter, we expect things to improve. And I think in FY22, we should be back. Our margins should be better than what we have posted in FY20.
Okay, understood. And just, to wrap it up, Mr. Subramaniam, you're looking at reducing dependency on FM business by focusing on activation, concerts, TV impact properties, online radios, third-party events. Now, given this entire lockdown, given the COVID pandemic, obviously companies will have to look back at the blueprints of their mega plans that they had for 2020, 2021, etc. So will this all now come to a standstill, or will the pie reduce?
So on-ground activities, our forecast for this year is that it is going to be lower. But we've sort of, as Prashant said earlier, we have sort of expanded our digital offerings. So we expect a growth in our digital business. But the overall revenue for FY21 will certainly be lower than, as it stands, right? Will certainly be lower than what we've seen in FY20 because, virtually we don't think there will be any significant on-ground activity, at least in the first half of the current financial year.
And to add to what Subbu said, the solutions business is primarily an attitude business, where we approach our advertisers and we tell them that allow us to find a solution to your marketing challenge rather than sell FCT or sell an on-ground solution or something. So when you take that approach of finding a solution, you find that there are many components which go into the solution, one of which has traditionally been the on-ground leg. And like Subbu said, that will be under pressure in FY21. But there are other components to it, other media that we package in the solution, which will not face downward pressure to that extent in FY21. Plus, of course, the digital legs, the videos that we do, the podcasts that we do, the social media activity that we do on behalf of a client, all of those actually should boost the solutions business. So I certainly see the solution business share going up in FY21, even though the revenues overall in FY21 may be down. because of almost the first quarter being locked down.
All right, gentlemen.